In a previous class, we studied different types of portfolios. We studied equally weighted portfolios, price-weighted portfolios, and market capitalization weighted portfolios. Once you understand what portfolio is and the difference across these portfolios, you can easily understand what an index is. Because an index is just the value of a large portfolio of assets. Whether it is a stock index or it is a bond index, an index is just the price or the value of a large portfolio of assets. In that previous class, as an example, we studied a portfolio of 3 companies' stocks, a portfolio which is composed of Royal Dutch Shell and Barclays and Marks and Spencer, only 3 companies. In contrast, a stock index is usually a portfolio of many companies. And most stock indices are market value weighted portfolios. For example, FTSE 100 or FTSE 100 is the portfolio of 100 major UK companies. S&P 500 is the portfolio of 500 major US companies, and so on. But the important point here is that stock indices are portfolios of lots of major companies. And these well-known stock indices are market value weighted portfolios. Now, some stock indices are price-weighted portfolios. For example, Dow Jones Industrial Average is a very long-standing US stock index which has 30 constituents. So this portfolio is composed of 30 US major companies. Nikkei 225 is one of the major Japanese stock indices, and it is a portfolio of stocks of 225 Japanese major companies. Finally, some stock indices are equally weighted portfolios, Barron's 400 Index, S&P 500 Equal Weight Index, or FTSE 100 Equal Weight Index. Okay? So, if you hear of any new stock index, you ask just 2 questions and you'll understand it. The first question is, what are the constituents? What company's stocks does that index contain? Second, how are they weighted? Are they market value weighted, or price weighted, or equally weighted? And if they are equally weighted, probably you would also want to know how frequently the portfolio is rebalanced in order to recover the equal weights. Probably every 6 months or every 3 months, and so on. Once you understand these things, constituent companies, how they are weighted, and how frequently the portfolio is rebalanced, you understand that index, it is just the value of that particular portfolio. Next question is, can we buy stock indices? You know, every day we hear those economic news programs on TV say, oh, today S&P 500 increased by 2% or FTSE 100 increased by 5%. When you heard this kind of news, you might have thought, okay, fine, those indices increased, but I cannot actually buy an index. It's just a number. I cannot buy it. But now you know that an index is just a portfolio of many companies' stocks. You must understand that in principle, you can actually buy a stock index. For example, if you buy those 100 major UK companies' shares, and if that portfolio is market capitalization weighted, then basically you bought FTSE 100. If you buy those 500 major US companies' stocks, and again if the weights are market capitalization, then basically you bought S&P 500 index, because the value of such a portfolio would coincide with the S&P 500 index. But you might still think, okay, fine, in principle I can buy a basket of 100 companies' stocks, but I'm not a billionaire. I have only 1,000 pounds. I cannot buy 100 different companies' shares. Well, actually, instead of buying 100 individual companies' shares, you can buy shares of an index fund. which is an ownership of a basket of constituent companies. If you go to a supermarket like Wegmans or Walmart or Marks and Spencer or Sainsbury, you can buy many different fruits. You can buy apples, oranges, mangoes, pineapples, and grapes. But if you have just $3 or £3, instead of buying many different fruits, you can buy that small fruits cup which contains many different fruits. Same idea. If you have just £1,000, you can buy an index fund for S&P 500 or FTSE 100. An index fund is just a basket of many companies' shares. And some index funds are even exchange traded, so buying them is as easy as buying an individual stock. Examples are Spiders, iShares. I think iShares is the brand of BlackRock. But anyway, these are exchange traded funds. Now, these passive funds, index funds, exchange traded funds, they do not exactly coincide with the index they are following, partly because, maintaining a portfolio incurs some cost, even if it doesn't involve any active strategic thinking. But they are close enough. Okay? Indexes can be constructed for different countries and for different industries, like an index for the banking industry or an index for IT companies and so on. Indexes can be constructed for bonds, commodities, currencies, and other assets as well. There exist many bond indices for many different government bonds and corporate bonds. There are currency indices. There are also asset-backed securities indices such as ABX. There are credit default swap indices such as CDX. There are also custom-made tailored indices. If you want, you can construct my favorite video game company's index or my favorite fast food company index. All you have to do is to decide which companies, which assets to include and how they weight them. Indices are informative because by looking at them, you can get some vague idea of how, for example, overall German automobile companies are doing, or how European governments are doing, or how Latin American currencies are doing. You can easily get an idea of the overall average performance of a category of companies or governments or countries. Okay, indices are informative. That's one reason why they are useful. But there is another reason why indices are useful. Once indices are constructed, they allow investors to bet on or against whether, for example, the overall stock market or technology stocks or bank stocks will go up or down. Because once an index is constructed, it can be used for a forward contract. For example, if you strongly believe that the US pharmaceutical industry will perform very well for the next couple of years, of course you can buy US pharmaceutical companies' stocks, but for that you need a lot of money to buy stocks. In contrast, if there exists an index, something like the US pharmaceutical company index, then instead of buying these companies' stocks, you can enter into a forward contract. You can take a long position of a forward contract that is based on this index. And forward contract is like a bet. So you don't have to pay anything today. You just make a bet with someone else. It's super risky. That's a bad side of a forward contract. But on the bright side, you need much less money than actually buying stocks. Okay? In summary, index is just the value of a portfolio of many different assets. There are many kinds of indices, and index is useful because it's informative and it also allows investors to make forward contracts and option contracts.